Today, I'm in Mayfair, London, to visit Kernow Asset Management, a contrarian investment manager focused on all-cap UK equities, both long and short. The team around Alyx seeks opportunities with highly asymmetric return characteristics where the investment thesis is differentiated relative to consensus. Kernow is the Cornish name for Cornwall, and so the company also has an office in Falmouth on the Cornish Riviera. As they are just getting settled in their new London office, we're having this interview at the venerable East India Club a few minutes away. So Alyx, please introduce yourself and your firm.
Welcome, my name is Alyx Wood and I co-founded Kernow Asset Management alongside Edward Hugo in 2019. We are a UK equity specialist, and what that means is we sift through the disregarded, the misunderstood, the esoteric opportunities to find risk-reward situations that are skewed in our favour. Put another way, we find hidden gems in unfashionable areas. The way we actually execute that is with our contrarian mindset, which is the most important thing, and that means we're a fundamentally driven mean reversion trader. And fortunately for us, the output of all this is that we get an uncorrelated high return stream from the UK equities, which is generally a pedestrian, very liquid market.
So I wonder, tell us more about your background.
I've been investing since I was 15, which is 21 years ago now, and I thoroughly enjoyed it, and I've made a lot of mistakes in the past, which has taken me on that path that I think is important to becoming a professional investor. And my professional stripes, I started at KPMG, where I was a management consultant working for investment banks and hedge funds, then moved on to a client at Deutsche Bank, working on the buy side, and then moving on to a boutique asset manager, really where I became a full-time fund manager doing something similar to what I'm doing today, and unfortunately meeting the rest of the team as well in my professional capacity, which is Ed Hugo, he's my co-founder. Ed's background is very different to mine. He studied a BSc in Maths and AI, then did a Master's in microsystems and nanotechnology. And probably more importantly, he was a head of equity research at an investment bank, so he knows what he's doing. And then the third key member of the research team is Mike, who has a PhD in physics, and he earned his colours at Man Group and then Lazard, where he did lots of really interesting things. So the team's a really interesting place. As you know, culture is really important to get right in firms if you're going to deliver. And the wider team also have different skill sets on the business and advisory side, but I'll save those for another day.
Now, give us also some more details about your investment strategy.
So we harvest the contrarian premium in UK equities, and to do that you need the right people, process and philosophy, as I'm sure you know. We've talked about people, so philosophy, contrarian, that's the word that I will use a lot. And contrarian investing works because essentially cash flows and business models move a lot slower than emotions and sentiment. And we take advantage of that. And the reason why that works is when we're presented with something in life, we underreact, and then massive overreaction. We live in the status quo until something becomes threatening or interesting enough. And those two tenets of the overreaction, underreaction, we apply to UK equities very robustly, and we're essentially trading those situations over a decent time period. The philosophy makes sense, and it should provide a decent return, but it means nothing unless you have a very, very disciplined investment process, which is a really, really important point. The investment process can be split into three simple parts. Simple but not easy, but number one, we value a company. Number two, we pay less for it. And then number three, we trade the catalyst. So number one, when valuing the company, we have valued every single company in the UK equity market above 100 million market cap. We track that in the Kernow Index, and we put a valuation number on each company. We get off the fence and say this is valued at this from our own valuation model. Part 2, we go to how much does it cost in the market. If I think it's worth $1 billion and the market says it's worth 500 million, that's quite a big gap. 500 million is a big gap, which means one of 4 things. We've made a mistake somewhere, so go find it. Number 2, there's a lot of noise, and we can't quite understand why there's a overvaluation or undervaluation that's material. Or it gets interesting. The market is scared of something, or the market is ignoring something. And that's when the real work starts, because if we can buy that sentiment element, and it might change in the future for some reason, sentiment or human nature we can trade that. Historically, what I've discovered is that the problem with this process up to this point is value traps, which is why the third part of our investment process is really important. So we're catalyst driven. That means we can spot these overvaluations, undervaluations, but we only trade them when they're material enough and there's movement towards the mean. And so what you're left with is, on a daily basis, we track all the valuations and then we link them to catalysts that we can discover. And when they move enough, they turn into trades, and then we track the investment thesis and we get paid over time. And so the strategy, in essence, is we know it's going to make money as long as things change in the future. And as long as the future is unpredictable, we'll do well. If the future all of a sudden becomes incredibly predictable, we won't do so well. And in my experience, and I'm sure yours as well, life is beautiful and lots of interesting things happen, which means I have confidence to put our livelihoods and our reputations on the line to produce the return that we're delivering to investors, and hopefully for the next 20 years.
So you mentioned the Kernow Index. Tell us more about that and how you actually use it.
So the Kernow Index is something I'm very proud of in terms of what the team have delivered. It's something I've done always on my own. And where we are now with the deep bench that we have is that we've produced a fully functioning Kernow Index. And what that is a mass valuation methodology. So put another way, we value every single company in the UK on a daily basis, and we track that valuation up or down as it moves with news flow or different inputs. And that makes our job very, very easy from a screening tool, because we can see where the big opportunities and dislocations to the share prices are, which makes our work a bit easier on the deep dives. And then we also have the catalyst tracker, which is the other side of the barbell. So the catalyst tracker is, on a daily basis, we say against our investment thesis and individual stocks positions, is that news flow good for the catalyst? Is it slowing down the catalyst, or does it challenge the catalyst? Because that's what we're trading. And over time, you get little snippets of information, and you have a color coding. So over months, years, you get, is it red? Is it green? Is it blue? And it tells you if you're getting a fade, or if actually you should be pushing harder on your positions.
But why the UK?
The UK for us is our home market. Culturally, we understand it, and this is where we've always worked. And we think we can sustainably do and apply the Kernow investment process and philosophy in this area. We don't want to, we know what our circle of competence is, and we don't need to push it any harder than that. In terms of the actual asset class, the UK is quite interesting. It's, I think the IMF said it was the 4th most advanced economy in the world. It's a deep liquid market. So there's 1,600 companies if you ignore the secondary listings. And also, pleasingly for me, it's getting more inefficient in my view. So you've got the structural decline of equity research, as I'm sure you're aware. Then also, culturally, in the UK funds sector, there's a lack of differentiated research. And as the companies are consolidating to one company, there's essentially a lot of index hugging going on. A lot of funds now are plus or minus 1 or 2%. You go back 10, 15 years, that might have been plus or minus 10. So things can get out of hand and quite easily, and that creates a lot of opportunity for us. The UK, since 2016, to say the elephant in the room, Brexit caused a problem, and over that period I still managed to annualise at 16%. But Brexit, I think, really was a disappointing result for international investors. I think it was a real cultural moment of, oh, these guys, hands off the table. Uncertainty moment, and investors just said no, either pull money away or we're not making a decision. And you're in a situation now where Brexit's happened, that uncertainty has become a risk. Investors have priced it in. We can see that the UK is moving on. And the UK is also sitting at, depending which metric you use, 30-40% discount to global developed peers. It's a once in a decade trade. And some of the international investors are coming back. Those under allocations are starting to come back in. At the end of the day, it's 4% or 4.2% of the MSCI World Index. You have to have some exposure to the UK equity market. And, the market essentially has priced it as if it's in structural decline and the UK is not going to exist anymore. That's certainly not the case. We can see how well the bustling city of London is doing. It's the largest financial hub of this time zone. And over the long run, it's beat its counterparts in Europe in terms of GDP. It might not do that in the future to the same extent, but it's certainly going to be near the top. So it's quite an attractive trade from an asset allocation point of view. And so it's a nice place for us to fish and not cast our net too wide.
So what would you say is special about your investment strategy?
Good question. So I would highlight 4 things: the enduring investment process, the in-depth fundamental research, the difficulty in replicating what we do, and actually I've recently learned quite interesting, the focus that we have on other investors. So the first part, enduring investment process. The problem with investment premiums is sometimes once they're there, you arbitrage them out into existence. Fortunately, the contrarian premium, as we have been tracking it, is very volatile, but it's very enduring because it's human nature driven and emotions aren't going to change. So we have confidence that it's going to continue to do well. In terms of in-depth fundamental research, that's our bread and butter. We find an awful lot of opportunities in the mid and small cap section, which makes sense because there's going to be more inefficiency in those spaces. And again, fortunately for us, that also happens to be where the growth in the UK market is. Our large caps aren't growing anymore so much, or if they are, they get taken over by international counterparts or strategic investors. So it's that certainly in the mid cap. If you look at the main indexes, that's where a lot of the disproportionate growth has been over the couple of decades. And then hard to replicate. Being contrarian from a sales perspective is quite difficult because you're doing the opposite to what's hot and what's not. You also have a bit of emotional resilience, and it has to suit, fortunately for me, it suits my personality. And there's probably easier ways to make money at a larger capacity level. Our capacity is restricted for the performance that we're going to deliver. So we just don't have much competition, which is nice, which means hopefully we can harvest more of the premium as well. The focus on funds. Everyone spends a lot of time on the companies and why and the characteristics. We say, how many funds are there? Who's taking money in? Who's not taking money in? What money's going into quant? What's money going into income funds? What money's going into growth funds? How big are they? They all tell you what they're buying, what they're selling. It's very public, particularly UK funds. International investors are a bit more tricky. And let's track them, because at the end of the day, fund flows do matter. That's going to push things either side. And I should have mentioned this earlier, a really important part of our process is when we get in, I know who I want to sell to. So when I buy a position, the catalyst is, I'm going to sell to this person. And this person exists. And what are they doing? Great. If I'm going to sell to this person but they don't exist, it's not going to be a very good trade. So to give that a bit of very naive colour, we buy a company that's increasing profits, they're currently not paying a dividend, the catalyst will be next year it results, they have excess cash, they'll pay a dividend. The majority of UK investors are income funds. They cannot buy you or take a meeting until you're on the dividend register. So they go on the dividend register, the story will be heard a little bit better. Maybe some of them will buy it, but it will certainly help the re-rating, which is the whole point of what we're trying to do over 18 months to 3 years.
And just in general, how else would you say are you different from your competitors?
Good question. So the way I frame this is essentially we sit in that widening gap between short-term orientated quant traders and the index huggers, and that gap, as I see it, is getting larger. To jump in and get a bit deeper, we've tracked, as you can imagine, our return profile against all the investors and other funds and strategies that we can find. And we have found only 2 return streams that look similar to ours. Having investigated and gone and spoken to those investors, and I know admired them for a long period of time, they have the best track records in the UK. They've got 15 and a 22-year track record, and they've annualised both at over 15% per annum. And you can't give them any money because they're closed to new investors for a good reason.
And from the perspective of investors, what would you say, which benefits do you offer investors?
Investors get access to a liquid market, and the Kernow strategy delivers a high return profile in a low correlation way. So in an otherwise pedestrian market that most people allocate to, we can basically kick out different return characteristics that hopefully add benefits to a diversified portfolio. Another characteristic over time, particularly on the sector allocations, is we provide a natural counterbalance to fads and fashions because of the nature of what we do, which means we can help in periods of transition. When things become more uncertain and sentiment moves a lot, we're there to generally make a decent amount of money. So that's certainly a benefit that I've seen from the investors that we have so far. And then, of course, we have different entry points for investors depending on their characteristics. It will be sovereign wealth funds, family offices, or institutional investors or private investors. And the most recent of which is the UK fund, which is weekly dealing. There's no gate. The fees are very clear and transparent, and there's no funny things inside the fund because that's where my money is as well. So, and then finally, the commitment of the team and the brand and the passion that we have is backed up by a commitment to not have too many assets. So we'll be capped about 500 million on the capacity, and why that's important is because it protects performance, which is the whole point why investors at the end of the day come to trust you with their money, and that's what we want to achieve. So we've capped it at that point that works for the strategy without having too much of a degradation that becomes material.
So, as we all know, the environment has changed quite a bit recently. But I would say these changes are actually in favor of your strategy. Is that so?
Yes, correct. So we don't have to predict the future perfectly. We just have to appreciate that things are going to change, or what people care about is going to change in the future. So we've been through a pandemic, war, the turning of interest rates, and now high inflation. And what we see is, because we take those trades that are outside of the consensus, we'll do well as things transition. Now, we don't have trades in every single possibility, so sometimes things will happen that we don't have a trade on, and then we miss the opportunity, and we'll drag anchor like everybody else. So this year, for instance, commodities and interest rates have been very good for us. Our portfolio is naturally positioned to do well out of those, and we've seen that. Inflation, apart from our gold position, which didn't quite work for inflation, we've got hurt just like every other investor in that area. And through time, we'll transition to the natural areas that the market is scared of or it's ignoring to the greatest degree. So our outlook is essentially in the Kernow Index, what's the size of the contrarian premium? Is it shrinking? Is it getting bigger? What's our factors exposures? What's our sector exposures? And where are we pushing hardest and where are we defending the most? And that's almost going to be a mirror image to the vast majority of other investment funds. And as long as unexpected things happen in the future, we're going to be okay.